you're going to see rate hikes. You're going to see this thing getting a little stiffer here. I would say now they're talking probably 4 rate hikes between now and 2023, which is pretty robust. I'll tell you, if they do that, you'd see 2 next year and 2 in 2023. So that's a lot of hikes. You're going to see this market really capitulate. I mean, we're down, what, 400 points right now, something like that? I haven't looked. And, this could be a rough summer for some of these markets as they head for the 10-year. And you'll see the spread, the yield curve spreading now. I mean, between the 10-year and the 2-year, which is normal. It always happens when they start talking about rate hikes. So we'll see. It's going to be interesting. But I think it's about time. Even though, of course, I like easy policy. It's great for what I do on the market. Stocks, of course, been flying. Rate hikes is going to definitely stiffen that game. And as you can see, bank stocks today were taking hits because it affects the bank stocks too. So overall, what's good for Main Street isn't good for Wall Street and vice versa. So I think this is good for Main Street. Going to be tough for Wall Street, but it is good for Main Street. Get those hikes in there. We've been spending too much money, Jackie. I mean, we were spending, what, $120 billion a month on this quantitative easing. And that's a lot of money, It's good for the bank per se, but it's not good for the bank per se, if you know what I mean. So it's good for banks. They get more interest rates. That's better for them. But at the same time, people are going to invest less in stock market. You're going to see prices across the board go down in companies' stocks, and that hurts banks, So in the long run, it's going to have a real bad effect, I think, on the market, and it's going to cause inflation. Yeah, you're going to see inflation creep up here. Now, I mean, it was up, what, 5%? Consumer price index was up 5% year over year. That's a big move. And I think that'll keep continuing, at least for the summer. So that's not good for the country and not good for the bank stocks either. People aren't spending. Well, yeah, because there are going to be sectors, and like you and I have been talking this before. I think the tech sector, if you're going to be in any sector for the long term, you want to be in the tech sector. I think that's going to have its ups and downs with the rates, but in the long run, if you invest today, you'll be happy you did. 5 years from now, 2 years from now, the tech sector will be up. It's not going anywhere. It's going to have this rolling effect a lot of times because of data coming out and interest rates. But it's going to be stable. It's going to be a place to be. I still invest in the techs. I like the techs. Anytime it comes in, I buy a little more. And I think, that's where you want to be. Techs are going nowhere. And as you can see with us, I mean, we do everything on Zoom now or on Skype or one of these platforms. And I'll tell you, Wall Street real estate, I think, is going to take a hit. Because even though it's starting to open, I think a lot of traders are opting out and saying, hey, I can do this from Miami. I can do this from, up here, the Adirondacks. As long as you're in the same area code, same time zone, you can have a nice life by doing it just on talking to Jackie Peng on the line here. That's it. So I think you're going to see that change. And a big part of that is due to technology. And it's just going to get better technology. So I think tech's here to stay. Real estate's going to get hurt in New York, but techs won't get hurt. Problem. This Fed has been not really proactive. It just gets behind and tries to catch up. It used to be when I first started on here, the Fed led the market. Now the market leads the Fed. And we saw it with, like I said, with consumer prices up over 5%, 5%, that the Fed's got to make a change. And with that $120 billion a month they were giving out, it wasn't working. It didn't really do that. It saves. But the problem is now, the market is so used to this. It's like a drug addict used to getting a shot of morphine or cocaine. And these markets are going to cry when they don't get that $120 billion a month. So it's going to be interesting, especially come this fall, to see how the market reacts. If, in fact, they start easing, like they said, stiffening up like they said they want to do rate hikes. So we'll see. But, yeah, it's going to be a shock to the market without that $120 billion a month. I do look for growth. I do look for the tech sector. I think, in the long run, you want to be in stocks where the growth in 10 years is going to be astronomical and the tech sector is going to be strong. It's just going to get bigger and bigger and stronger. Like I mentioned, you see just in our little community, the financial community, tech is such a big part of it now. From this pandemic, we realize we don't have to be on the floor of the New York Stock Exchange. We don't have to be on Wall Street. And I think that is going to flourish tech. It's just going to go all over the place now. Not only Wall Street and financials. I think you're going to see it in certain retails. I mean, you're seeing it in Amazon, of course, but I think that's going to get bigger and bigger. And I believe, you want to be in the tech sector growth. That's the main place. Real estate, I'd be a little, leery of real estate right now, because now people, like I said, they can move out to cheaper areas, cheaper tax zones, and things like that. So you got to play that smart. I wouldn't be buying condos in New York City anytime soon, put it that way. But there are sectors, like I said, the banking sector I think will be strong. Healthcare is going to be strong. That's not going to go anywhere. Healthcare is going to stay strong. So overall, I still see pockets where we can get invested, but you got to be risky. You got to go slow. You can't just jump in. Do your homework and listen to Jackie Pang. No, it, it's all on the dollar right now, and you're 100% right. The dollar's acting so strong now, and people are going to run into it right now. It's a place to be. If you look across the world, remember, we look at the world markets, not just the U.S., but around and smacked around. It affects all those, and I'll tell you, emerging markets are going to get hurt out of this. So basically, the dollar is the safest place to be now for this week. We'll see what happens next week, but right now, the dollar is where you want to be.